Let's move on to the third and the last technical session for the day. For that session, we have with us speaker CA.V. Ramnath from Coimbatore. And to introduce the speaker, I request CA.A.B. Geeta, Regional Council Member, and followed by which we will have the e-felicitation for the speaker.
He has more than a decade-long association with Coimbatore branch as an eminent faculty for CA Final Direct Taxes. It is therefore not an exaggeration if I were to say passion towards teaching was found expression in him being a member in the academic and governing council of various educational institutions at Coimbatore. At the spur of knowledge, sharing and gaining continues, the session today is another skill of enrichment endeavor with the area for discussion being various assessments pertaining to partnership entities. Without further much ado, on behalf of SIRC of ICI, I take this opportunity to welcome CA Ramanathan sir to share his views on the issues faced in IT assessment of partnership firms. Over to you, sir.
Over to you, sir.
The chairman and other members of the SIRC and all the branches of SIRC and senior members of the profession who continue to guide this profession, fellow members who are participating in this mega event, a warm good evening to one and all. Without spending much time, let us get into the subject proper because we are already over. So the topic is partnership firm issues faced in the assessment under the Income Tax Act for partnership firm. So all of us know very well in 1992 there was a paradigm shift in the assessment of partnership. Prior to that, senior members would acknowledge that we had a different set of understanding of law for the assessment of partnership. After 1992, it underwent a series of change, and the first change was the allowing of interest and remuneration to partner was the first change came in 1992, financial year 92-93. Section 184 came up with the conditions. So the conditions for assessing the firm to be assessed as such those days was to say that that partnership should be evidenced by an instrument in writing. Share of each partner must be specified in that instrument. A copy of the instrument certified by all partner other than minor to be filed along with the return of income in the first year in which that partnership firm was formed. And whenever there is a change in the profit sharing ratio or change in the constitution of the firm, a copy of the revised instrument of partnership should be filed in the year of such a change. This was, and one more condition is there, subsection 5 is there. Now, those days when we were manually filing the return of income, the first year of filing the return of income for the firm, and any year in which profit sharing ratio underwent a change or a constitutional change took place, the true copy certified by all partners will be attached along with the return of income. So afterwards, the returns became annexure-less returns. Nowadays, we are only filing the return. How do we say we are complying with this condition? Is a question which we will have to address ourselves. So now, Section 139C and 139D categorically say that all the returns will be annexure-less, and in case as per law, wherever annexures are required to be given, since because of this new scheme we are not giving any annexure, officers are entitled to serve a notice under Section 139C asking the SSC to furnish the annexures. In case those annexures are not furnished, then return to that extent may be regarded as defective under 139(9), where those 139 criteria not complied with, and other consequences will follow. In case such notices are not coming, these annexure-less returns, because of the fact the certified true copy of the partnership deed is not appended, it would not be considered as Section 184 is not complied with. Now, extending this analogy in a faceless assessment, where the assessing first after filing the return, we are now in the early days of faceless assessment. So now in this scenario, the faceless assessment procedure, the notice says file the deed. a copy of the deed, whether that deed needs to be a certified true copy or an ordinary deed. If there is no change in the statement, in the PSR, or in no change in the constitution, then an ordinary deed would be sufficient. But even otherwise, whenever there is a change in the constitution of the partnership firm or change in the profit sharing ratio, a revised instrument of partnership duly certified by all partners may be kept ready, and in that year, if a faceless assessment comes and a copy of the deed is asked for, better to file that, so that the section 185 can be said to be complied with, though unless there is 139C notice comes, one need not give. As a safer side, we can give that. Otherwise, after 139C notice comes, it is necessary for the assessee to furnish a true copy of the instrument of partnership. Otherwise, an ordinary copy of the partnership deed, even without signing by all partners, would be sufficient. The last condition, subsection 5 of 184, is very important. That says, notwithstanding anything contained in any other provisions of this act, where a failure under, as mentioned under 144, takes place in the assessment of the firm, the 184 benefit of allowing interest and remuneration to partner would not be available. So the first 4 conditions will be very comfortable. There must be an instrument in writing in which profit sharing ratio must be specified. Wherever there is a change in the constitution, we will have to give. Otherwise, every first year we'll have to give, change year we have to give. These are very comfortable, but this is something which generally gets unnoticed. If the firm ends up with a best judgment assessment under section 144, then in that best judgment assessment, any interest or remuneration claimed by the partner shall not be allowed as deduction. So if the firm ends up with a failure contemplated in section 144, necessarily no deduction by way of payment of interest and salary shall be allowed to the firm. Therefore, firm should always take precaution in ensuring that section 144 is not triggered. 144 talks about failure to furnish the return of income, failure to comply with the notice of 143(2), failure to comply with the notice under 142 subsection 1, failure to comply with the direction given under 142 2 capital A to 2D, audit contemplated under the law. With the approval of the PCIT, the officer would ask for the audit accounts to be audited again. If there are failures of any one of these 4, failure to furnish return, failure to comply with 143(2), 142(1), 142A, then necessarily the officer has to assess the firm under section 144. If such assessment is framed under 144, deduction by way of interest and remuneration cannot be claimed. Therefore, having claimed interest and remuneration, if the firm is careless in following up the notices, then that interest and remuneration will not be allowed as deduction. Of course, as per section 185, consequently, the amount of disallowance which took place will not be allowed, will not be taxable in the hands of the partner concerned. What is allowed as interest and remuneration to partner in the assessment of the firm will alone be allowed, will alone be taxed in the hands of the concerned partner, otherwise not. So therefore, to that extent, there is an advantage. This is the only provision in the entire income tax act, to my mind, says that if there is a disallowance in the paying assessee's hands, correspondingly in the hands of the recipient, there would be adjustment of not taxing the particular amount. In all other cases where there is a 48(2) or 48(3), etc., merely because there is a disallowance in the hands of the payer, corresponding adjustment cannot be claimed in the hands of the recipient of the money. But this section provides for relief to that extent. Of course, this has been further enshrined in section 28 clause 5 proviso, categorically saying, to the extent what is allowed in the hands of the firm will alone be considered as allowable, taxable in the hands of the partner concerned. There are few other important aspects, basic aspects to say. If there is a restriction in the local law to form a partnership doing a particular business, even the Partnership Act may permit, in that case, forming a partnership where there is a restriction in the local law, assessment under partnership as partnership is not possible, then that particular entity would be regarded as AOP. And the Supreme Court has endorsed that the relationship of sub-partnership is well acceptable when one firm is funded by another firm represented through a partner. That relationship of sub-partnership is acceptable. and a partner in a particular partnership would not be able to say, I am doing this particular partner, in this partnership, I am a partner in two capacities, one for myself, one for somebody else as a representative. Such a dual capacity is not possible. It's some important aspects on basic of forming partnership and continuing it. Now, the controversy starts on the liability side of the balance sheet in the very first year and subsequent year whenever there is an increase. So what happens first? In a case where the partner contributes capital to the partnership firm, that is to be tested for the conditions of section 68. So when partner contributes to the capital of the partnership firm, officer tries to test that credit. Now, section 68 demands for identity of the person, ability or the capacity of the person, genuineness of the transaction. When a partnership firm receives money from a partner, naturally identity is proved, genuineness may not be in question, but the question is about capacity. So when capacity is proved, section 68 is satisfied. If the capacity is not proved, then section 68 would trigger, then it will be considered as income in the hands of the firm. Can a partnership firm argue that this is the very first year? How would you presume that the firm has undisclosed income? Therefore, the firm has introduced the undisclosed income through the partner, which is failing. Therefore, in the very first year, you cannot tax it. Those theories are slightly far-fetched. Earlier days, these theories were accepted, but now section 68 mandates that it has to be. Therefore, such a theory in the going forward, the recent days, this is not accepted. Therefore, the mandate gets triggered. Section 68 is getting triggered, and all the more the consequence will be severe because of the application of section 115 BBE. When section 68 is sought to be introduced, obviously the impact would be on the rate of tax, 60% and 25% and 4%, thereafter penalty of 6%, apart from that 234B. These are the consequences likely to follow. Now, if the partner gives by way of an affidavit that he has given money, but he is unable to explain the source, can he own up and say, I have an undisclosed income out of which I have given, I will bear the tax? Why should firm be worried about? That is the area where the line of demarcation is very, very slender. When a partner says he is really given money, but he is unable to make it up, can the liability be shifted to the hands of the partner is a question, which if all other partners have given identically the same amount, this partner has also given, all other partners have got adequate amount of sources to prove their ability, capacity, and this partner fails, and facts may be so sufficiently available enough for the firm to establish that everybody has contributed, he owns up, he is an income tax assessee, let him be taxed. It's purely fact-based proposition the firm can advance. And in that scenario, the liability can be moved from partnership to partner, provided partner is previously assessed and he has got any history to say he is an income tax assessee, etc., whereby he has some undisclosed income which he has introduced. Therefore, liability to pay tax should be only on his hand, not in the hands of the partnership, an argument which a firm could take provided the facts are sufficiently able to be established. On the contrary, if there are only two partners, both happen to be husband, wife, or brother, or family members, and one is able to prove, other one is not able to prove, these sort of arguments should be slightly difficult. But on facts, there are altogether different friends or different non-family members or partners. Out of 5, 4 are able to establish, 1 is unable to, then the firm can take this play, which we will have to see. Now, interestingly, the assessing officer tries to say the firm has got money which is unable to be proved, therefore I will invoke section 68. But in the course of the hearing, the partner has agreed that he has given, but he is unable to prove. So therefore, the idea was to see that the firm is absolved from this controversy and let the tax be levied in the hands of the partner's hands. So now the officer, one hand, taxes the partnership firm. Other hand, in that given case where the assessing officer of that partner is also the same assessing officer, therefore he reopened the case of the assessee partner concerned and says, you claimed you have invested money in the partnership for which you are unable to prove, therefore I'll say it's an unexplained investment. Under 69, I will tax you also. for the same amount. Now the SSE says, how can you blow hot and cold? Now you say, it's a partner money, he has undisclosed income, he has paid into the partnership, you tax the partner concerned. Contra, if you are of the view firm has undisclosed income introduced in the name of the partner, then tax the partnership. For the same amount, how can you tax twice? A very logical proposition, no doubt about it. But unfortunately, in this judgment which I have cited, Jagmohan Ramchandra case, Allahabad High Court has said such a proposition of taxing the partner and partnership on two different sections by the assessing officer is nothing wrong. It is upheld. It's a dangerous proposition where Allahabad High Court has upheld. So therefore, the SSE has to make the point very clear to say whether it owns up in the hands of the partnership or in the partner. Otherwise, sometimes this sort of judgments may, on a very weak case, prove to be wrong and would put the SSE in trouble in more than one place. Now the partner contributes in cash. What would be the next issue which one has to factor? In case if the money comes in the capital account or in the current account of the partnership concerned, then we have to test the applicability of section 216 ST. So per occasion, per incident, less than 2 lakh, fine, agreeable. Again, facts of the case. If the entries are made in the book for more than 1 day and in all aggregate it is more than 2 lakh but individually less than 2 lakh, and the SSE on facts able to prove only in the respective dates the monies have come by a corroborative evidence that money which came in are utilized by the firm either by banking it into the bank account or to the expenses, etc., then that each entry is an independent occasion where one can say it is not going to be clubbed. But by facts, it goes to say that the assessee firm received the money from the partner on a particular day, but entries are only split, then the aggregation principle may be invoked by aggregating the number of entries made, so that if that aggregated number exceeds or touches 2 lakh rupees, 269 ST may be invoked. Now, instead of capital and current account, if the partnership firm maintains a loan account of the partner in which entries were made as contribution from the partner concerned, partner's loan account is credited to that extent, and if that entry in that particular account is 20,000 or above, or opening balance itself is already touched or crossed 20,000, then that loan account may be visited with section 216 SS. So one has to be very careful in claiming that the money had come into the capital account or loan account. If the money had been accounted through loan account, then one has to be careful that the section 216 SS is not getting triggered. Otherwise, revenue has got a very good case to say money received from the partner is on a loan account. Therefore, section 216 SS can be applied. Now, credit comes to the partner's capital account not by way of fresh capital, but by way of assuming the liability of the partnership. Let us say, for example, there is a liability of the firm which partner undertakes and says, hereinafter I will pay this liability. I'll get credit, you credit my account, transfer the liability from the partnership to my capital account, I will pay, not a problem. When a liability of the firm is taken over by partner, now we'll have to see how it is settled subsequently by the partner concerned. In case there is no settlement at all, it may give an impression that the liability itself is bogus. If it is subsequently settled, no problem. If it is not subsequently settled, then one has to examine whether section 28 would apply, or 41 would apply, or 56 would apply, or it could be argued that's a capital receipt in the hands of the partner concerned. Similarly, on facts, by making an entry into the hands of the partner, from the partnership to the partner, the liability gets ceased only at a later point in time, where the tax liability would arise in the hands of the partnership or in the hands of the partner, a moot question to be seen. Now, on conduct, if the partner has taken the liability and he started serving partly, subsequently a part is settled and balance is not settled, or an interest is paid, principal not paid. In those cases, it is on fact, it is proved that the liability is already moved on fact. In that case, subsequently firm would not be in trouble. It is only the partner who has to face the music. But after moving the money account from the partnership firm to partner, afterwards there is no entry at all in the books of the partnership for partner for several years, and thereafter partner claims it is ceasing to be in existence, then the liability can be in the hands of the partnership itself, by saying that the entry moving from liability of the firm to the partner is only an accommodation entry and there is no real transfer or real moving of liability from partnership to partner, then the liability may come in the hands of the partnership itself. But on conduct, if the partner is able to say that he has taken the liability, he started paying, after some time a portion gets waived. If the liability originally created in the books of the firm is an account of a trading liability, a purchases, an expenditure related liability is taken over, in that case section 41 would get triggered. If it's an advance received and subsequently performance is not made, therefore forfeited, business receipt 28 can come. Whether section 56 would come, very doubtful scenario. Capital receipt, on facts, if these are not falling into any one of these cases, partner may be in a position to say it is a capital receipt. For example, they have borrowed a loan, interest was paid over a period of time. Subsequently, partner negotiates with the lender and says, I'll pay part of the money and I'll not pay the balance. Principal waiver of the loan. In that case, 56 would not apply and capital receipt could be argued. And of course, we have the Supreme Court judgment to say that principal waiver would not be liable for tax in Mahindra case. So therefore, the subsequent reduction of that money taken over or the liability taken over depends on how the liability got created originally. If it's a trading liability, 41 would come. If it is a advance received in the course of the business subsequently cancelled, section 28 can come. And 56 very doubtful it would not come because there is a consideration. Capital receipt would be a better case. But at the threshold by the transfer entry, whether firm is exposed to section 269T because the loan is settled otherwise than by account pay cross to check. If at all the transfer is a liability in the form of a loan, if it's a trading liability, etc., 269T would not come. If it's a loan, then definitely it is possible to say that it is liable to be tested for 260. Technically 269T would apply. But going by Delhi High Court judgment, the objective of 216T is to curb the cash transaction. It's only a journal entry. Therefore, one can say the purpose of introducing 216T is only curb cash transaction. That is not attracted here. Therefore, 216T should not be applicable. But as a precaution, those cases voluntarily the SSC should incorporate in class number 31C of the tax audit report form number 3CD. If the SSC says we will not do it, para 3CA of 3C, para 3 of form number 3CA or para 5 of 3CD, the 3CB, the chartered accountant should draw attention that these are the transactions which technically lead to violation of 216T, but however, considering the object and interest, SC is saying that it is not in violation, therefore nothing is reported. Now, contribution of assets from partner into the partnership. Now money, instead of money, the money in the kind, something comes in kind. Now the immovable property is received. Section 45(3) applies only in the hands of the partner. Correspondingly, nothing is available in the hands of the partnership. So those days itself, when the Sunil Siddhartha Pai Supreme Court judgment came to say, in the hands of the partner, when you are transferring the assets, the thing is taxable. To get over the judgment of the Supreme Court, 45(3) came to say, it is amounting to transfer and the amount recorded in the books will be considered as consideration, deemed as consideration. Now, on the contrary, in the hands of the partnership firm, what to do? Now, when we receive it at fair value, no problem at all. If at all we receive it as something less than the fair value, can one test under 56 to 10? Going by Sunil Siddhartha Pai, one can say that when the asset is received by the firm from the partner, it is not a transaction liable for tax at all. One very good argument. Suppose somebody do not want to take that such an extreme level argument and adventurous proposition, then there is a receipt of an asset. Receipt of an asset, then that asset happens to be an immovable property. To the stamp duty value, the amount has to be accounted for, failing which in the hands of the firm 56 to 10 can be triggered. And if at all there are 9 more movable assets received like shares, securities, jewelry, etc. by the partnership firm, then same 56 to 10 would come. The value should be reasonable to the extent of 11U. Otherwise, again 56 to 10 come. If the asset received is neither immovable nor specified movable, something else, furniture, motor car, etc., the value is what is recorded is sufficient. There is no testing under 56 to 10. But if the assets received is not movable, immovable, movable as capital asset, what is received is a current asset, then what would happen? In the hands of the person giving also, 45(3) will apply for the capital gains chapter, not for business. So in the hands of the person receiving, 56(2)(10) would not apply for current asset, will apply only for capital asset. Therefore, if the firm receives the asset as a current asset, obviously the triggering of 56(2)(10) avoidable. But in this case, facts were such that they have played too much, and therefore the Honorable Delhi Tribunal Special Bench said even if you introduce current asset, 45(3) could come, which is a fact related judgment. Therefore, one need not generalize it. Now, when we are receiving the assets, either motor car, furniture, any other asset, and or a building in an immovable property, then when we are claiming depreciation, when the value of the asset is less, 56(2)(10) comes. And the value of asset is more, 56(2)(10) would not come. But if the value is too much, the assessing officer can invoke explanation 3 to section 43 clause 1 to say the accounting is only for the purpose of enabling the recipient to claim more depreciation. Therefore, they will substitute the fair market value. Therefore, increasing or decreasing too much is not going to be an ideal scenario. Explanation 3 to 43(1) need to be factored. Very interestingly, we have divergent views to say when a partner introduces into the partnership the land or building, whether a registration first of all necessary, depending on the state laws. Respective states have got their own registration related provisions. We have judgments. Bombay High Court went on to say in case of partnership firm giving property to the partner, registration is mandatory. However, we have Supreme Court judgments, other two judgments quoted, where the law said when a partnership firm distributes to the partner, registration is not warranted. The individual can say the firm asset becomes his assets. This can be relied on, but however, having a reference to the state law would always be good. Otherwise, after the partnership gives the asset to the partner or the partner gives the asset to the partnership, subsequent dealing in those immovable properties may trigger some difficulties in case properly registration is not addressed, issue of registration is not addressed. If a rural agricultural land is introduced by the partnership, by the partner into the partnership, and the value is less than SDV, whether we would have to test it under 56(2)(10), we have one judgment in 19 of the Jaipur bench of the ITIT say a rural agricultural land is not a capital asset. 56(2)(10) applies to capital asset, but however, that capital asset should be read as something opposed to current asset. Therefore, section would apply. But the subsequent Jaipur judgment of 2020 July says 56(2)(10) would not be applicable. For that matter, in case where the rural agricultural loan is purchased at a price less than its SDV, the same Jaipur ITIT comes with a different judgment, which we'll have to wait and see how these are going to be reconciled. When a partner is happening to be a non-resident partner introducing assets into the partnership, now two things. One is that non-resident partner is a related person, and the partnership firm and the non-resident partner is a relationship. Therefore, transfer pricing provision would get triggered. We'll have to see carefully the transfer pricing provision. And in case by introducing asset, there is a capital gain, that would trigger section 195 and consequential provisions have to be taken into account. That is on the liability side when the assets are the income, assets are the cash or introduced, cash or bank balance introduced. Now we'll go to the next scenario, payment of interest. Interest is paid on the money so received or the assets received. We know well section 40 small bit discusses about the conditions for claiming the interest. Now the law does not make any distinction in the language of amount introduced in the form of capital or current account, loan account. As long as the deed authorizes payment of interest on the capital account, on the current account, loan account, by whatever name you call it, you are entitled for it. Alternatively, if the deed says only interest on capital and assessee claiming on the current account, loan account, etc., would definitely invite trouble. So if as long as it is authorized by the deed for the entire contribution, it is possible to calculate. Now, in case we would like to calculate the interest, what is the methodology? The daily product method is the most scientific method. One assessee went to the extent of averaging the opening and closing balance and saying my opening balance this much, closing balance this much, I'll aggregate, divide by 2, on that I'll calculate interest. The assessing officer said so much of variations in between, I'll go by daily product method. The Cochin tribunal went to the extent of endorsing the AO's view that daily product method has to be preferred as against the opening balance, closing balance, averaging the contribution made by the partner. Now, out of few partners, one or two had taken money from the partnership, and now on aggregate put together there is a positive number. In that case, whether debit balance in some partner account would be required to be charged with interest. Now, facts only would elaborate the case better. In case partners are maintaining capital separately, current separately, all partners capital account positive, all partners current account, some of them negative, some of them positive, but altogether positive. Partners have decided to claim interest on capital only. Current separately kept. In the current account, aggregated number is positive. Claiming interest on partners capital account is not a problem. But they would like to claim interest on both capital and current account put together. In that case, when they are charging interest on the current account balance of the partner, the debit balances have to be necessarily charged with interest. Only on the credit alone charging interest, leaving the debit balance is not appropriate. But aggregated becomes positive, not an issue. Now, slightly elaborating this issue, one partner has drawn money, all others have contributed money, all capital current put together, everything put together becomes negative. In that case, if the interest is charged, safe. If the interest is not charged, then any borrowing available in the hands of the firm to the extent of the net debit balance can be considered to be applied for non-business purpose, and therefore interest on such borrowings may be liable for disallowance. In that case, if the entire debit balance is charged with interest, to that extent there would not be any disallowance one can contemplate with reference to the borrowings for which interest is already paid. Now, some of the SSEs used to follow the method of not providing depreciation in the books of account, however claiming depreciation in the computation of total income. As a result of which, the asset value is remaining as it is, or they will charge very meager depreciation, as not as per the Income Tax Act. The asset value is more, so the charge of depreciation in the P&L is less. Consequently, the profit appearing is more. Amount so credited in the profit and loss account added to the capital account is also more. Next year, that is the basis for claiming interest. So now, next year, the assessing officer says, previous year you charged a lesser depreciation. That resulted in more profit. That resulted in adding more capital on which you are claiming depreciation. That is not permissible. I'm going to rework and give you only lesser interest on capital in the current year. That action of the assessing officer was not endorsed by Madras High Court. So Madras High Court has gone to the extent of saying that you will not be able to disturb the previous year numbers. You would like to say book, you are maintaining some policies or you are having a policy of not depreciating asset, that capital is always entitled. Anyway, it is getting taxed in the hands of the partner, therefore it is not required to be worried. Now, when an assessee follows 44 AD principle, whether charging of interest is mandatory or otherwise, again depending on the language employed in the deed. If the deed says the interest shall not exceed a particular number or interest shall maximum of this, which shall be decided on every year through a resolution, etc., then assessee can demonstrate that they have not done and therefore they have not drawn money. The deed says mandatorily it has to be given. Then after offering that much income, interest has to be allowed, and thereafter balance will be taken as share income. Again, taxability would happen in the hands of the partner. That's a danger associated with. Other than 44 AD cases, again, as per the deed, if it is mandatory, it has to be provided. As per the deed, if it is not mandatory, one can avoid. In spite of the fact it is mandatory, an assessee may choose not to provide for it, but this will lead to litigation. If the interest is paid to the partner, and one partner happens to be a non-resident, for all resident partners, whenever we are paying interest by crediting to the capital account, etc., we are not worried about TDS provision, because 194 capital A subsection 3 says interest to a partner will not be liable for TDS, but 194A talks only about residents related payment. When a non-resident happens to be a partner, happen to be a non-resident, then naturally section 195 would get triggered, and tax has to be deducted at source to the extent of the interest paid to the non-resident partner, failing which section 40A1 would get triggered. In addition to that, section 201 subsection 1 proceeding would come, 201(1)A interest will be leviable. Therefore, when partner happens to be non-resident and that particular firm, when interest is sought to be claimed, we'll have to be careful in ensuring that for the non-resident partner, TDS provisions are appropriately applied. Coming to salary, again, interest should be similar to interest, it should be authorized by and in accordance with the terms of the instrument of partnership. There are two important aspects which we'll have to keep in mind. If the deed is silent, how much ever is the qualification, knowledge, experience, etc., one would not be able to claim remuneration. Reverse, if deed is authorizing, but the person has not endorsed or a person has not really given qualification, yes, given services, even if there is an authorization in the deed, salary cannot be claimed. So factually, there must be service rendered and authorization in the deed. Failing which either one of the things are missing, definitely the provision of salary to the partner would be liable for questioning. Now, early days, reproduction of the 40B clause, quantification, etc., was early 92 to 96 accepted. Thereafter, circular went on to say a deed should clearly say the quantum of remuneration payable to a working partner or the manner of quantifying it. You will have to say clearly. So now, people started reproducing the deed in the deed itself, section 40 small b language, first 3 lakh 90%, balance all 60%. They've done this reproduction of the entire text of that is permissible, provided other things are satisfied. Who is the managing partner? For which partner out of this, how much to be given? If that is given, nothing wrong in it. Mere reproduction of the clause 40B with reference to quantification is not impermissible one. That is permissible. But one has to take care, very importantly, who is the managing partner or working partner? That has to be very clearly specified. And for each of them, how to divide this total remuneration, that has to come. If that is there, then reproduction of 40B is not a problem. Now, it should be payable only to a working partner, non-working partner, not a possible scenario. Working partner is so defined in explanation 4 to say, means an individual who is actively engaged in conducting the affairs of the partnership firm. So therefore, only an individual can be entitled to take as remuneration. If in some of the states, HUF is becoming partner representing through an individual, when salary is written in that particular partnership firm, ideal to take that salary component alone in the individual status, interest can be considered by HUF, nothing wrong in it. And whatever we have said for the 44AD cases, whether claiming of remuneration mandatory, etc., what we said for interest will equally apply for remuneration as well. Whenever there is a change in the quantum of remuneration, what precaution one has to take? Very important aspect, especially in the recent days when manual attachment of the deed was not there and it's only the annexureless written. This is something which has to be taken note of, which slightly was taken back seat, especially in the faceless appeals related matters. Now this is picking up. When the deed says this is the sum, you would like to increase or decrease. Now we would like to increase, for example, ideal to alter the deed. When you would like to decrease and the deed says this is the amount, lesser than that partners can decide by a mutual understanding, etc., then a resolution is fine. And if the deed says this is the amount, increase or decrease, either way, partners can decide. I personally feel that increase or decrease through a resolution is something always going to be troubling, even if the deed authorizes, so far as it is an increase is concerned. But if it's a decrease, maximum is authorized by the deed. Lesser than that, only partners are deciding. So authorization is there. In accordance with the second link, that's important. There, the deed provides for deciding by the partner, by the partnership, by a mutual arrangement through resolution. Resolution should be proved to be accounted or entered on that relevant day. If the evidence suggests that it is backdated, the case would be getting weakened. So therefore, better to have a minute book, have the resolution documented there periodically, so that the resolution is backed appropriately by evidences. And making a resolution at the end of the year is not appropriate. Making a resolution at the beginning of the year as to what would be a quantum of remuneration chargeable or receivable by each partner is ideal. After the end of the year, if you decide it is amounting to only an afterthought, it will be considered as an afterthought. Therefore, it is considered as application of income. Whatever in the deed is already accrued, and thereafter partners are waiving that. In that case, partners' hands before waiver, whatever is there, can be subjected to tax. And if the partner happens to be a non-resident partner, payment of salary to him will also be subjected to 195, because Payment of salary to a resident partner is not hit by 192 because there is no employer-employee relationship. But payment of salary to a non-resident partner would be hit by section 195. Of course, this is something we know about quantification, but the language categorically says the net profit as computed as per chapter 4D. That means business head. In a particular year, if there is house property income or a capital gain, we should not count that. Peculiarly, Mumbai Tribunal said if at all capital gain and other sources, you can count that also for the purpose of quantifying your eligible book profit. I am unable to subscribe to this particular view with due respect. If there is an adventurous assessee, one can experiment this. Now, having finished the interest and remuneration, now let us go to the next aspect, 40A2 related provisions. Now, 40A2 not necessarily for partner, any partner's relative, etc. are also covered. Now, three things are there. Fair market value of the goods received or services obtained, legitimate needs of the business, benefit derived from this particular activity. Depending on these three, the assessing officer is of the view that the amount paid is excessive or unreasonable, he may disallow that excessive portion or unreasonable. Very interestingly, the assessee argued that the conditions to be cumulative. That means all the three AO has to satisfy. Any one is not there. But on Gujarat High Court said if any one is attracted enough, considering fair market value of the goods, amount paid is excess. Other two I don't need to see. Fair market value of the goods are only paid. However, that is not required for this business. You have purchased and kept it. You paid money. Therefore, I am disallowing. Benefit derived. All the three can be independently tested. But however, courts have said that the testing has to be done only through businessman's perspective, not from the wooden-headed form of only technical way one should take it up. Now, other provisions relating to partnership form would be 44AD and 44AE. Much discussed about applicability of 44AD in case of partnership form. Only one aspect which one has to keep in mind is when we compute the presumptive income for a 44AE cases, we are entitled to further claim the income, the interest and remuneration payable to partner. In case of 44AD, after quantifying the presumptive income, it may not be possible for us to further claim interest and remuneration to partner. This is already deemed to be given effect to. Claiming it once again may not be possible at all. Now, again, if we say it is already claimed, to the extent of already claimed that the partner would be exposed to tax again, in spite of firm paying tax on the presumptive income. That is where the deed plays an important role. If the deed provides for maximum, subject to the resolution being framed by partner consent, then one can demonstrate that partners have not been paid interest and remuneration. So presumptive income for which tax is paid by the partnership, nothing was claimed by the partner as interest and remuneration, as well as partnership did not claim it. Therefore, nothing is taxable in the hands of the partner. Depending on the language of the deed, this has to be taken up. Now, the firm continues to go under 44AD. Now, how much is the amount one has to consider for source? Amount of presumptive income plus the depreciation actually allowable under the Income Tax Act. To that extent, one can say there is a cash resource available for investment. One has to make this reconciliation. If the amount available for source is something less compared to the actual investment made by the firm, then the firm is going to land itself into trouble. Section 44AD does not give a clean chit to the organization to say you can offer 8% or 6%, but you can have 30%, 40%. One has to be very careful in quantifying the amount eligible for investment, presumptive income plus GST plus the depreciation. Now, in practical life, when a partnership firm is planning to purchase an immovable property, the firm's detail and the represented by partner's detail will be given. Ignorantly, sometimes the partner will give his permanent account number, firm will give permanent account number, the AAR information will contain the partner's permanent account number. Therefore, in the AAR of partner, it will appear partner has purchased property. So that would put the partner into trouble in scrutiny. Therefore, ideal to show the partner's permanent account number in the deed for representing partner any other address proof other than the permanent account number, so that in AAR, the partner will not unnecessarily demonstrate he did not purchase this, it's only firm which has purchased this. Now, we have seen only the introduction part of it. On that withdrawal part of it, we have host of controversies available. Money withdrawn by partner during the course of running a firm, whether 216ST would apply, 216T would apply, or money credited to the account and next day money is drawn, whether 48(3) would apply. I personally feel by conduct, salary paid, lump sum beyond 20, 10,000, but however credited next day paid, 48(3) can be available. Instead of money, assets are withdrawn, 45(4) would come or not. If it's a capital asset, 45(4). If it is a current asset, then 28(1) would come or not. Going by Sunil Sudhar, the boy, etc., one can argue that withdrawal would not trigger taxation at all. Very interesting proposition. Honorable Madras High Court has said it would not trigger except for distribution. Other things should not be there at all. Very interestingly, on distribution requires more than one person involved to distribute. One person is taking the asset during the course of running a firm, that's amounting to distribution. Therefore, 45(4) would not apply. Therefore, the taxability itself would not apply. One can take a view. So, cash withdrawn during the retirement over and above the capital balance, nothing is taxable. Other than cash, assets are taken away. Honorable Madras High Court and National Company said that is also not taxable in the hands of the partnership. Partner also would not be exposed to tax, is what they view. However, 56(2)(10) one has to really test it. Of course, very interestingly, number of issues are there. Only one aspect, let me say, considering the paucity of time. When a firm is converted into company, when company is downgraded into LLP, etc., we'll have to be careful that conditions are properly complied with. Otherwise, that would, if at all some small portion is kept as a current account of a partner, which is given in that 5 years time, then it is amounting to consideration paid to the partner, otherwise then by equity share or capital, and that small portion for rounding of purpose, we will pay some small portion in cash. In the after conversion, that would trigger entire exemption getting diluted or exemption getting violated and the exemption getting withdrawn. So that should not happen, which one has to keep it in mind. 222 is another controversy where we'll have to be extremely careful that a firm receiving money from a company in which the partner has got the interest in that company, definitely this issue would come under 222E. So therefore, only one tip, I think the organizer will permit me to finish this tip. When a firm has got partnership, firm has got two partners, the same people happen to be the shareholder in a company. When a person holds 10% share in the company is a specified shareholder. The firm in which this person has got 20% above, that gentleman happens to be a person in whose firm this person has substantial interest to trigger this provision. Let us say husband and wife company shareholder, husband and wife partnership firm. On fact, husband has got 91% share in company, 9% share in the wife is holding 9%. Now that wife has got 81% in the partnership, and the husband has got 19% in partnership. When there is a transfer of money between husband, firm and company, the person in the company's book, the shareholder who is holding more than 10% is not having interest in the partnership of 20 or above. Therefore, tax would not come. Is something which one can plan around depending on the language. For the purpose of this section, for ascertaining the substantial interest, assessee's share of profit is alone relevant. We are not required to club the percentage of share of profit of the family member, spouse, etc. is what I would like to say, considering the time available. My sincere compliments to the organizers for the excellent work done by them and all the people who have been involved in making this particular event mega success. And thank you one and all for your patient listening. My apologies for extending the time and making some senior people to be here in spite of their routines of taking their dinner before 8, etc. And however, for the time available, this much was what I would like to share. Thank you one and all for your patient listening.
For that informative sessions, sir.